Is it possible to profit from the stock market's shifts without spending 8 hours a day chained to a computer screen? If you spend any time online, you've seen the advertisements. People in Hawaiian shirts promising $5,000 trades from a beach, provided you buy their patented system. Back in reality, swing trading is not a path to overnight wealth. Anyone suggesting otherwise is likely hiding the fact that they took a reckless risk that happened to pay off by chance. Even high-performing swing traders generally aim for annual returns between 20 and 30%. Attempting to force higher returns usually involves taking on the kind of risk that eventually erases an entire account. You can go to a roulette table and bet $10,000 on black, but that isn't a financial plan. Building lasting wealth in the market requires moving past the illusion of the quick jackpot and adopting a grounded, statistical approach. Most participants get trapped in one of two extremes. The first is day trading, which demands impeccable timing and the mental stamina to handle minute-by-minute anxiety while staring at flickering price charts. This chart illustrates the contrast. The top shows the hyperactive volatility of a day trader. The bottom represents buy and hold investing, sitting through months-long crashes. Swing trading offers a middle path, capturing clean momentum in the center, cutting out noise and deep drawdowns. This strategy is engineered to be nimble and opportunistic, allowing you to participate in market moves without being tethered to a desk. While day traders clear their books every afternoon, swing traders hold their positions over several days or a few weeks. The objective is to capture short, powerful price moves on either the long side or the short side of the market. Because the time window is limited, the exit strategy is ruthless. Unlike a long-term investor who might wait for a struggling company to recover, a swing trader exits at the first sign of poor performance. This requires a dual-layered approach. They use technical analysis to identify timing through chart patterns, but they also check fundamental data to ensure the underlying company is healthy enough to support the move. By combining these two disciplines, the swing trader moves with a surgical edge, relying on data rather than hope. Identifying the right stock is actually the least important part of this equation. There is a different discipline that determines whether a trader survives the year or loses everything. Risk management is the priority. In this environment, protecting your existing capital is more important than the pursuit of new profits. Trading coach Van K. Tharp demonstrated this by testing a system that entered trades at total random. The system remained profitable because it applied a strict exit rule. It cut every losing trade immediately, while allowing winning trades to run. By ensuring the few winning trades were much larger than the many small capped losses, the math forced the account to grow. Long-term success doesn't depend on being a market psychic. It depends on becoming a master at containing losses. Achieving the freedom of a swing trader requires you to embrace a set of highly disciplined, unglamorous habits. You need a rigid trading plan that specifies exactly when you enter, how much you risk, and when you take profits. This removes the emotional impulse to hold on to a losing trade. You must also calculate your exact investment returns. Without accurate data, it is impossible to know if your strategy is actually performing better than a basic index fund. A trading journal provides an objective record of your performance. By documenting the logic behind every trade, you can identify recurring mistakes and technical errors that would otherwise go unnoticed. Financial independence in the market isn't found through intuition. It is manufactured through repetitive, bureaucratic discipline. When you master these tools, you gain the ability to capture powerful market momentum on your own terms. You avoid the exhaustion of day trading and the anxiety of watching a long-term investment crumble during a market downturn. The middle ground in the financial market is accessible, provided you respect the risk and focus on the fundamentals. To start building your own trading plan and master the mechanics of the market, follow Money Mysteries.